Coming up, we're talking with the bank's CEO, known for balancing growth ambitions with community and customer responsiveness. That's right, my man Steve Williams and me, Alan Dominic, are incredibly excited to welcome Archie Brown, the CEO of First Financial, to this new episode of Plugged In. So, Archie, what's happening, my friend?
Al, it's really good to be here on Plugged In. First time. I'm looking forward to our talk today.
Well, hopefully, long-time listener, first-time caller is what we're going to describe you as.
Right.
Steve and I love to, hop on this show and talk about some of the, quote, troublemakers that are doing some really wonderful things in our industry. And the way we do this is we try to pull some songs that might, give us some inspiration as we, kind of wander through the next 20 minutes together. So I have 5 songs that I'm going to surprise both of you with. Neither of you have seen them, but I'll acknowledge that as I was putting the, quote, set list together, I took a minute to look at the Cleveland Fed's website. And again, only bank nerds understand why you'd be listening to music and going to the Cleveland Fed. But they had written a little piece on you in July of 22, so maybe a month or two after I had joined Cornerstone. And I remember seeing it, and there was a line that stood out that I want to just make note of to get everything going. And so these are your words, Archie. If you remember when you said, hey, look, there's going to be adversity, things that go differently than we expected in all of our lives. You said at the time, nobody planned on COVID, but it happened and we had to respond. You just keep moving, applying what you've learned. There are going to be better days. And so as our resident optimist, I just love that message. And I thought we might try to apply it in this conversation. So Steve, are you go with me using a quote like that to get our friend Archie teed up?
I am. I want you to connect it to a song somehow. Can you do that?
Well, let me pull the strings because I was listening to The Cure as I was looking at this and Pictures of You came up. And so that song, I don't know if you remember, it starts off, I've been looking so long at these pictures of you that I almost believe that they're real. I thought the pictures I'm imagining would be a bank that has 10 years of average annual returns on equity of over 17%.
Right on.
And in that period grew earnings each year at above 8%. And Steve, you were telling me it's been 139 quarters of profitability and today a dividend yield of 4%. So with The Cure in my head, I say to Archie, that picture sounds pretty darn sweet. So how can a high performing bank like yours get a little bit more respect like The Cure used to get respect from everyone listening to the radio?
Yeah, Al, I think it's interesting because I always think of the other Better Days. The Better Days, was it Resnick that sang the song Better Days?
Yeah, Goo Goo Dolls.
And it seems to me that in many ways, these are the best of days in terms of you just look at, the economy is still solid and bank performance is actually really, really good right now. But investors aren't in love with us at this moment. And so I think there are better days ahead, hopefully for investor sentiment. And somebody asked me in the last week, what do you do about that? And my answer is you control the controllables. There's nothing else you can do. It's very frustrating. And I'm not the only person leading a banking company, especially a mid-sized banking company that's feeling that frustration. But you just focus on the things that you can control, and it just keep getting better. And you mentioned what we said back in Cleveland back a few years ago, but this idea that you can always just you can find things to keep getting better at, and just do that, control the controllables, and at some point the rest of it's going to have to work out.
Yeah, Steve, you talk like this all the time. You want to build on what Archie
I think Archie, I see 2 things. I think the market tends to overweight the fear of 2 things. One is competitive disruption, like somebody announces stable coin or the next digital thing or next fintech and say, oh, they're going to be under threat, but we evolve and we'll talk about evolution. Second thing is, I don't think the market understands just how different credit is in this era than it was 10 or 20 years ago. And so I think, something comes out of the woodwork with an auto dealer and the broad swath gets painted, or office gets painted the same way in downtown New York City as, a 2-story dental office in Ohio. So that's where I think is the challenge, is making sure they start to understand the new world of credit risk. And secondly, that we can evolve with competitive disruption.
Yeah. And Steve, you're saying that it's like history repeats, or no, history doesn't repeat, but it rhymes. Mm-hmm. And so there are lessons that we should remember from 10, 15, 20 years ago, because they give, I think, banks like what Archie's running a little bit of cushion that should attract people to realize, hey, this is a stable franchise that's performing on a recurring basis. And that is a really cool thing to be a part of, let alone to be leading.
Yeah. Well, I'll just say it real quick. When you say the backstop of capital, plus the backstop of a loan loss reserve, plus the backstop of collateral, plus the backstop of guarantees, I don't think people understand just how buttoned up things are in most cases around credit than some of the stories you hear outside of banking and shadow banking today.
Archie, you think that we're a fan of what you're doing?
Yeah, I appreciate that. That means a lot. I think there are a couple of reference points I think about. Still, it seems like the public investors use as their reference point the great financial crisis, right? Everything kind of gets back. Oh, and to your point, Steve, well, one, most things aren't like that. That was kind of a one in 100-year sort of thing.
Right.
And two, banks are so much healthier than they were, even in levels of capital, levels of liquidity. Management teams are so much stronger. Risk management practices and controls are so much better. All those are true. But the second reference point is 2023. And I think investors look at that year, what happened in March of that year with several banks that failed kind of, almost overnight. And they go, wow, gee, I never expected that. And so there is, for the smaller banks, the non-universals in particular, there is a view that we don't know what's on the balance sheets. Could that happen to any one of them that we don't know about? And we think they're solid. So there's always this risk that I think investors think about now. They probably weren't thinking pre-2023.
Good point.
And our view, I kind of think a lot what you said, Steve. There's been probably 4 or 5 intervals of investors saying, oh, no, they have hotels, or, oh, no, it's food industry, or, oh, no, it's office loans, or, oh, no, it's, you pick the next one, right? And you saw what happened with a couple of banks in the most recent earnings release. And it kind of then everybody kind of freaks out a little bit. And I think what we've demonstrated over the course of time is we are in the risk management business. Credit losses are going to be part of it. But even today, credit losses are so much lower than they were historically. If you think about where they are today, 15, 20 basis points. They're
right.
So for mid-sized banks, they're so much lower. But yet we're in the business of managing those risks, and we've got the talent, the skills, the balance sheet to handle things when they do come up.
Yeah. No, and I think what you're saying is so important for people just to really listen to and respect, because, you're competing with a lot of different players. Some of them are known, some of them are unknown, and when I think about the regulated industry that we're, living in, if I think about your competition with the big guys, right, it can be daunting. But I know that in a recent investor presentation, you said that there's huge opportunity to be a better alternative than the big banks in some areas like commercial and wealth banking. And so I queued up the New Radicals and their song, "You Get What You Give." Because I think beyond the cliche of personal friendly service, I'd love to hear what the bank is doing in those areas to really differentiate across the entire client experience. Sure.
I use that statement a lot because I think for mid-sized banks, we're just a hair over $20 billion in assets. And for a mid-sized bank, you have to figure out what can you be really good at, and then go hard at it. And look, we are built on legacy community bank markets. That's where we get our good core funding, and we need to continue to foster that for sure. But the thing that we can differentiate ourselves in is a commercial banking and wealth banking focus to middle market companies. And what we found, I'll probably just use Cincinnati as a good example of where this germinated from. There, if you look at the top 7 bank deposit players in Greater Cincinnati, we're the only one that's a midsize. All the others either universals or there's a super regionals from the Midwest that you all know about. But we're the only one that's different. And what we have found is we've been able to recruit. So what's the secret sauce? We've been able to recruit best-in-class bankers, typically trained from those larger companies. They come here because we can be more responsive. We can be more flexible, customize solutions with our clients, provide access to decision makers. We still have a very broad product set. If you look at our product set compared to most midsize, it's very robust. So we take all that and put it together, and then it's just executing on that. So we've been at it a while now, and what we're finding is, in this market in particular, we're gaining actual deposit market share. We're taking house accounts from competitors in the marketplace, and every year, adding another nucleus of those. And we're kind of an employer of choice when it comes to middle market talent. So that's what we do. And then we're trying to replicate it in other places where we think we can get that advantage.
Yeah, being a magnet for talent is something that Steve and I have talked to other guests on Plugged In about, because that, I think, really starts the competitive advantage. If you get the right people in place, then you can start talking about the products, the services that you're providing, and then you can start looking at your financial performance. But, without the people component, you're going to just be swimming upstream.
Archie, you said something, though, I think important, which is we got to keep the product set at least close to the nationals and the big guys, so that the talent doesn't come in and just lament, oh, when I was over at PNC, we had this and that. I think you're saying that we've really kind of kept that a lot better than we used to on just product, treasury experience, wealth experience. I think that's huge difference in terms of chance to compete today.
Well, and Steve, we've bought several non-bank companies that have added capabilities. We bought a foreign exchange company. We bought an equipment finance company. So we've added some of those capabilities that way. Plus, we've built our own and developed it. And then I would also say technology. You've got to be willing to invest in really good technology that helps us be more responsive and get things done quicker, easier, less friction. So we use the best in class origination technology in commercial banking, and we're focused on that kind of work all the time. You want the right product set, you want the good technology that enables those bankers to do what they do best.
Yeah, never use where a commercial bank is an excuse not to lean into tech. I think that's the difference today that I see from 10 years ago. Yeah,
and Archie, you said something that just jogged a memory. Actually, it was last week, I was listening to Mike Mayo from Wells Fargo talk about AI and investments that big guys are making. And he said, look, Goliath is winning. And obviously that's a nod towards the Morgan Stanleys, of the world. But he also had somebody on with him who said, hey, but let's not forget, community and regional banks have opportunities to move faster, to have less layers of decisioning, and they're closer to their customer. So their data on what they could be potentially using from a tech standpoint could actually be leveraged faster. And so I love that just kind of insight that you're providing, that you've got opportunities to make sure your team can do the right thing the first time for your clients. And it's not going to be this layer upon layer of bureaucracy just to figure out what's on the meeting agenda, the next week.
Well, I do think you're right. The advantage we have in having less layers does let us be quick in generally how we respond. I mean, if a banker wants me to go see a client or call a client, it's literally an email or pick up the phone and call me. And, that happens. And I'm back to them that same day and we go with it. You can get that done in a company like ours, along with these other improvements. And look, we don't have the resources of those universal banks you're describing, but we've got great vendor partners, and they're bringing a lot of those tools into our workplace too, that we adopt and we put in place. And just another example for us is just in the last 2 years, we've reduced our FT count by about 8%. And it's really using tools, technology, identifying where we have capacity, improving processes because of our tools. And the AI energy for us is certainly take out cost, make processes quicker, easier, reduce friction for clients. And that it becomes that virtuous cycle we've heard about. We keep doing that, we can reinvest in the business quicker.
Yeah,
absolutely.
Well, it also, what you're saying, it kind of leads into my next question. And Steve and I are going to be in Nashville together. So I wasn't planning on using this artist, but it's Kenny Rogers and his song, The Gambler, right? That line, you got to know when to hold them. You got to know when to fold them. You got to know when to walk away, and you got to know when to run. And so I'm curious, as you think about, your footprint and your capabilities and how it's expanded over time, how have you figured out where to double down on opportunities versus where you want to say no? Like, maybe you could help us understand what the decisioning process really looks like for you and your team.
Sure. Well, I mentioned earlier that trying to figure out what we can do best, and for us, that is probably the commercial and the wealth space. So, I heard Steve, I think it was one of the roundtables I attended with you guys years ago. Somebody who was really good in wealth, and we weren't at the time. And I remember asking the question to that person, how'd you get there? And he kind of said, I hated it every step of the way, but after 25 years, I'm glad I did it.
Right.
and And it's something like that. So we've got a huge commitment to building out the commercial platform, the commercial business and the wealth business. So we just keep investing. Now we're expecting returns and we're getting those returns, but we just keep investing to get better and better in those businesses. Again, it's people, it's technology, process. We keep doing it. So that's an area we do that. And I'd say fairly liberally, but with rigor in terms of the discipline and expectations. And then other areas we sort of, we control. You're not going to see us, for example, put tons of branches out. I could go in some markets, put 15 branches tomorrow in a metro area, and then I'd never see my return. So there are areas like that you have to think more about. And it kind of gets into acquisitions as well. We've, for 8 years, we did no bank acquisitions. We did, I think, 4 non-bank acquisitions. Primarily, they came as kind of opportunistically, but they gave us fee revenue. If you look at our fee revenue, for example, it's about 30% of total revenue, which we're an outlier for a mid-sized bank, and it came from those acquisitions. So we get fee diversification or revenue diversification or earning asset generation that incrementally adds, but we were able to buy them within certain financial disciplines. We just announced our two bank deals this year. One we closed in November. One we hope to close in January. But again, they've got to fit a certain financial discipline, but they also have to fit a strategic discipline. Meaning, in our case, do they help us with our core funding? Do they help us with market share in markets that we're invested in? And are they of the size that the execution risk is low? And then, of course, they've got to meet the financial hurdles. So we think about things in that realm and generally go fairly methodically through those kind of decisions.
Yeah, no, that's awesome. Thank you.
No, and it's definitely an outlier, Al, the 30%, Archie, because when everybody was growing their balance sheets in the zero interest rate era, that ratio kept going down. And now most mid-sized banks are in that 15 to 20% where you're at 30.
And Steve, you think about it, that's with a margin of 4. Right. So
exactly.
If we're a little more asset sensitive, as the Fed brings that down, that revenue as a percent it'll go up a little bit more. So we're pretty proud that it's where it is with a margin that high.
You bet.
Yeah. Hey, Steve, I'm going to toss a question your way.
Yeah.
A little curveball in our plugged in way of doing things.
Okay.
Who's the king of pop?
Michael Jackson.
Okay. What's your favorite Michael Jackson song?
Man in the Mirror.
Oh, you want to hum it for us?
I'm looking for the man in the mirror. Ow!
We're not paying any royalties for the karaoke moment, but you and I were talking about pop music at one point, and you've got an analogy or like a memory, maybe is a better way to describe
memory,
this.
hanging up with Archie.
Some time with you and Archie. And so I wanted in your words, not mine, about why the king of pop would be making an appearance on Plugged In.
Okay, it's this. Long ago in Indiana, hanging out with Archie when he was running what's now part of First Financial Main Source Bank, and we were having an officer retreat. I was one of the speakers there. And back then we were talking about digital and mobile disruption. And Archie said, banking's like pop music. The style's going to change, how we deliver it, what it sounds like, but it's still pop music. And you were saying, I think, team, we can evolve. And you have. So what's your thought on that? Can you still be pop music under different genres of banking today with the shifts you see with fintech, embedded finance, technology?
I do think, and what Bill Gates said years ago, banking is going to remain. How it's delivered, how people use the tools, that's going to change. But banking is going to continue. But yeah, I think in the context, see, that's like 10 years ago too. It's been a while now. But I think in that context, I had seen, you see these disruptors come from all realms, and my view was, in most cases, many of them, they don't. At the end, if you look at the end of life, they end up being acquired and rolled into something else, but they influenced the business in a big way. And that was kind of the idea that over the years, pop music's been influenced by all sorts of new things, but it still remains. And I think that's kind of been the case for banking. I do wonder, in the world we're in today, what traditional kind of the business I'm in, the kind of traditional banking, does it long-term remain? My sense is, from a client perspective and a community perspective, it does. I think what we do is really highly regarded and needed in our local communities. You don't see a universal bank lending in its local community the way we do, right? And making the kind of impact locally. So I think from that side, we do. The question is, from an investor side, I'm not sure what that's going to look like. But yeah, I think all these things just make us ultimately better at what we do and give the client something better. So yeah, I still think that basic underlying premise is true.
Yeah.
And Steve, you're very kind. You could have just said to Archie, "What's your favorite song? Do you want to sing along with me?"
No, I love it. I think
but I don't think I would have sung it. So.
Yeah, it is like how much can we evolve? Are we going to be, William Shatner doing an album or something really bad? But we've evolved on the commercial side. I think that we're going to see an interesting era of tech and to commercial and wealth, like you said, where it's been a lot of focus on retail. I think that's going to be an interesting area, and the integration of data and tech into the different industries you bank is going to be one of the big stories, I think, next 5 years.
Yep.
All right, so you're bringing William Shatner up as a potential musician. I don't know if I need to say live long and prosper.
They're horrible. If you go to YouTube.
We don't have to go to YouTube. We could just paraphrase it here for everyone and save them the trouble. But maybe I want to end with something a little bit more recognizable. So the song Good Times Roll by the Cars is one that I have been listening to recently, and I obviously love it. Let the good times roll. And I was just thinking about how we could tie this into leading in a digital first world. And so the way I think about this is, you're talking how pop music continues to evolve with technology, with different cultural moments. Leadership does the same exact thing. It looks different today than it once did, but it's still about setting the right tone. It's not about title. It's about the person and the personality, and so in a digital first world, employees, just like your customers, now expect answers and access to pretty much anything they want, whenever they want it, and are really surprised when you don't give it to them. So I'm kind of interested, just to wrap this all up, is like, how has the shift to digital really changed the way you lead, and how do you stay connected to people and make sure that the mission is maintained when so much happens through a phone screen these days?
You're right, Al. It's that part's changed a lot. And if you think about it, even it was interesting though, before the pandemic, we were already in a world where people were working in different locations, right? It wasn't the old style where everybody's in one building anymore. We had leaders and managers and professionals all over the footprint. And if anything, the tools in the last 5 years have just helped make that so much better than it would have been prior. I mean, we had people in Indy regularly talking to, but it'd be a conference call, or the video technology is so much better today. So I think it's enhanced it, and from that side, it's allowed us to be more creative in work solutions. Most of our folks are in most of the time. We have some that are in, like minimum 3 days, but so we can still maintain a lot of the culture with that, but provide a little more flexibility, which I think matters, especially to younger professionals. So we've had, I think, to adopt or adapt in that way. We're a really big bank on engagement. We focus heavily on engagement. We've been a Gallup partner for years. We did it, Steve, in the old shop at Main Source. We've been doing it here now 6 years. Most recently, we're in I think this year's survey, we're 98th percentile of all Gallup companies. We're an Exceptional Workplace Award winner this year, top 3% of the Gallup companies. And I'd say if I boil it down, it's a view that everybody's got something that they bring to the table. And our job is to help them identify that, and then harness it. How do we then bring it, in so we can all use it? So that's the mindset. And so it's a heavy focus on managers, helping them be the best they possibly can be when they work with their teams. It's a heavy focus on using tools like strengths finders. So management development, strengths finders, and just an overall focus on core engagement principles is where we spend significant time. We then communicate with town halls and in-person market rallies and a lot of community events and involvement we do to try to, reinforce kind of the basic principles. But that's sort of it. And I think for us, we found that it's working really well.
Well, we love it. We love that we could rally you over to the cause and hopping on Plugged In. So I'm just going to say on behalf of Steve Williams, the whole Cornerstone Advisor team, and me, Al Dominic, our thanks for getting plugged in with us today.
Great to get caught up, Archie. Thank you.
Thank you. Appreciate what you guys do. Have a good day.
If you enjoyed today's Plugged In episode, make sure to hit that follow button on Spotify, Apple Podcasts, YouTube, or wherever you're listening. We've got more great conversations coming up, and you won't want to miss them. Thanks for tuning in.